Have you ever dreamt of earning money while you're on holiday, spending time with family, or just relaxing at home? That's the dream of passive income. Instead of trading time for money, your money works for you, growing quietly in the background. The stock market is a powerful way to do this, letting you earn dividends as companies share their profits. Over time, this can help you build a more secure financial future while you live your life. Let's imagine you've come into a bit of money. Perhaps it's from an inheritance, a bonus from work, or maybe you've been diligently saving up for a rainy day and have managed to put aside a tidy sum of £20,000. It's a significant amount of money, and the big question is, what should you do with it? You could put it towards a deposit on a house, buy a new car, or go on that once-in-a-lifetime trip. Those are all wonderful options, of course. But what if you could use that money to create more money, year after year? Leaving that £20,000 sitting in a standard savings account might feel safe. But with interest rates often struggling to keep up with the rising cost of living, its real value could actually be shrinking over time. This is where the idea of investing comes in. Instead of just letting your money sit there, you can put it to work. By investing that £20,000 in the stock market, you're not just hoping it will grow. You're actively planting a seed that has the potential to grow into a money-making tree, providing you with a regular harvest of passive income. The figure of £20,000 is interesting because it's substantial enough to potentially generate a meaningful income, but it's also an amount that many people might realistically be able to save over a period of time. It's not lottery winner money, it's an achievable goal. So, the question we're going to tackle in this essay is a very practical one. How much passive income can that £20,000 really earn you? We'll look at the numbers, explore the different types of investments, and give you a realistic picture of what's possible. Throughout this guide, we'll break it all down in simple, easy-to-understand terms. We'll avoid the confusing jargon and focus on what you really need to know. We'll look at how to get started, the potential returns you might expect, and crucially, the risks you need to be aware of. The goal is to demystify the world of stock market investing and show you how, with a bit of knowledge and a sensible plan, you can turn a lump sum like £20,000 into a powerful tool for building your financial independence, one dividend at a time. What's the difference between active and passive income? Active income is money you earn from working. If you stop, so does the pay. Passive income is different. You invest time or money up front, and then it keeps earning for you, often with little daily effort. Like a vending machine, set it up once, and it can make money day and night. That's the key, building systems that give you more financial freedom and options. Now, let's focus on how the stock market, which can seem so complex from the outside, can be a brilliant source of passive income. When you buy a share or a stock, you're not just buying a digital number on a screen. You are purchasing a tiny slice of a real-life company. For example, you could own a small piece of Marks & Spencer, Tesco, or BT. You become a part owner or a shareholder. As an owner, you are entitled to a share of the company's profits, and this is where the magic of passive income from stocks begins. Many established companies, especially the big, well-known ones, choose to distribute a portion of their profits back to their shareholders. This payment is called a dividend. It's essentially a thank you from the company for your investment and your trust. These payments are typically made on a regular basis, often every 3 or 6 months. So if you own shares in a company that pays dividends, you will receive a cash payment directly into your investment account, without you having to lift a finger. It's your money working hard for you in the background. Let's use a very simple example. Imagine you invest in a company and its shares pay a dividend of 50p per share each year. If you own 1,000 shares, you would receive £500 in passive income over the year. You didn't have to attend any board meetings or manage any staff. You just had to be a shareholder. This money is yours to do with as you please. You could withdraw it to help with your living costs. Or you could do something even more powerful. Reinvest it to buy more shares, which we'll talk more about later. This is the fundamental way that stocks can become a passive income engine. By carefully selecting and buying shares in solid, profitable companies that have a history of paying dividends, you are effectively building your own portfolio of tiny businesses that send you a share of their earnings. It's a wonderfully straightforward concept when you strip away all the jargon. You are not trying to play the market or get rich quick. Instead, you are methodically building an asset that is designed to pay you a regular, passive income for years to come. So, you have your £20,000 ready to go. The first step, make a plan. In the UK, a stocks and shares ISA is a brilliant tool. Any income or growth is tax-free. Next, choose a provider. Compare fees, reputation, and ease of use. Opening an account is simple. Transfer your money in, but pause before investing. Take time to set your goals. This foundation makes everything easier. When investing for passive income, focus on dividend-paying options. You can buy shares in blue-chip companies like Shell or Unilever for steady dividends, but picking stocks takes research and carries risk. Many prefer funds, which pool money and diversify across many companies, reducing risk. Index funds and ETFs are popular, low-cost ways to access dividends from top companies. A mix of funds and a few individual shares can create a balanced income-generating portfolio. Let's break down what your £20,000 could earn. The key metric is dividend yield, the annual payout as a percentage of your investment. For example, a 4% yield on £20,000 means £800 a year, often paid quarterly. Find a fund with a 5% yield? That's £1,000 a year. Higher yields can mean higher risk, so balance is key. Remember, yields aren't guaranteed, dividends can be cut, and fund values fluctuate. Diversifying across reliable dividend payers helps stabilize your income. Realistically, expect £600 or £1,000 a year from a £20,000 pot. Steady, not spectacular, but a solid start. Stories of overnight millionaires are everywhere, but they're the exception, not the rule. Chasing huge, fast returns is speculation, not investing, and it's risky. Promises of 20% plus annual returns are usually sales pitches, not reality. Even legendary investors rarely achieve those numbers consistently. Sustainable wealth comes from patience and realistic expectations. Your goal isn't a lottery win, but a dependable income stream. Ditch the get-rich-quick mindset, slow and steady wins. So, what's realistic for your £20,000? A diversified portfolio typically yields 3 to 5%. That's £600, £1,000 a year. Add in potential capital growth, and your total return could reach 5 to 8% annually. Some years will be better, some worse. Markets fluctuate. Focus on long-term averages, not short-term swings. Don't panic if your investment dips. Look at results over 5, 10, or 20 years. Aim for steady growth and income, not quick wins. Patience and perspective are your best tools. Compounding is the real magic of investing. Reinvest your returns, and you earn profits on your profits. For example, a 7% annual return on £20,000 grows to nearly £77,000 in 20 years if you reinvest. versus just £48,000 if you withdraw gains. The longer you let your money compound, the greater the effect. Start early, be patient, and let time do the heavy lifting. Compounding turns modest sums into substantial wealth. Forget get-rich-quick schemes. Compounding is how you get rich slowly and surely. That's the real secret to long-term financial success. Investing isn't risk-free. Your money can go down as well as up. Capital risk means your £20,000 could lose value during downturns. Dividends aren't guaranteed. Companies can cut or cancel them. Inflation erodes cash savings, so investing helps preserve purchasing power. Diversification protects you from single company disasters. Emotional risk, panic selling or greedy buying can sabotage your returns. Stick to your plan, ride out the bumps, and avoid knee-jerk reactions. Awareness and discipline are your best defenses. New investors often fall into a few traps. Lack of diversification, betting everything on one stock, is risky. Trying to time the market rarely works. Staying invested is smarter. High fees quietly eat into your returns. Choose low-cost funds and platforms. Analysis paralysis can keep you from ever starting. There's never a perfect time. Start small and learn as you go. Letting cash sit idle guarantees loss to inflation. The biggest mistake, not investing at all. Getting started can feel daunting, but it's simpler than you think. Commit to a plan and choose an investment platform. Most in the UK start with a stocks and shares ISA for tax benefits. Opening an account is quick and can be done from your sofa. For beginners, a low-cost global or FTSE 100 index tracker fund is a brilliant starting point. Automate your investments. Set up a monthly direct debit, even a small amount. Don't obsess over daily market moves. Review your portfolio once or twice a year and let your investments grow. Beyond opening accounts and buying funds, successful investing is about mindset. Patience is key. The market has ups and downs, but history shows it recovers. Stay focused on long-term goals, not short-term noise. Define your own success, meeting your goals, not chasing fads. With patience and knowledge, you'll turn investing into a source of empowerment and lasting wealth. Your journey to financial freedom starts with a single step. By investing sensibly, like putting £20,000 into a diversified, low-cost fund within a tax-free ISA, you can build a steady income stream and grow your wealth over time. The real magic is in compounding. Reinvesting your dividends turns small gains into a snowball of wealth. Don't let fear hold you back. Start today, and your future self will thank you.